The most expensive tax in America is not the one printed on your paycheck. It is the one that arrives quietly after the government spends money it does not have. You do not receive a bill from the IRS for it. You do not vote on it directly. You do not see a line item in your bank account that says hidden tax paid today. But you pay it anyway. You pay it at the grocery store. You pay it at the gas station. You pay it in rent. You pay it in insurance. You pay it when a house that once looked reachable suddenly costs 17 times what it did a generation ago. You pay it when a car becomes a monthly burden instead of a practical tool. You pay it when your wages rise, but everything you need rises faster. That hidden tax is inflation. And the cruelest part is that inflation does not hit everyone at the same time. That is what most people do not understand. When a government spends trillions more than it collects, the money does not enter the economy evenly. It does not fall from the sky into every household on the same morning. It moves through channels. It enters through banks, bond markets, government contractors, asset markets, credit markets, and institutions that sit closest to the source of new money and new borrowing. Some people touch the new money first. Some people touch it later. Some people never touch it directly at all. They only meet it after prices have already risen. That difference decides who builds wealth and who merely pays more for life. The person who receives new money early can still buy assets at yesterday's prices. The person who receives it late buys groceries, rent, gas, tuition, and housing after prices have already adjusted. One person receives fuel for wealth. Another receives a higher cost of survival. That is the first lesson. Inflation is not equal. It is a transfer. It transfers purchasing power away from people who hold dollars, earn wages slowly, and own few assets. It transfers advantage toward people who own assets, receive capital early, and understand where money flows before the rest of the country feels the price increases. This is not a conspiracy. It is plumbing. If you understand the plumbing, you stop being shocked. Now look at the government. Problem: the federal government collects trillions in taxes, payroll taxes, income taxes, corporate taxes, capital gains taxes, estate taxes, excise taxes, tariffs, fees. Local and state governments collect even more through property taxes, sales taxes, tolls, and other charges. Americans are not living in a low-tax world, no matter what slogans people use, and yet the government still spends more than it collects. When a government expects to collect around $5 trillion and spend around $7 trillion, the difference must come from somewhere. That difference is the deficit. It does not vanish because people ignore it. It does not disappear because politicians speak confidently. It must be financed. There are only a few choices. The government can raise taxes, but voters dislike higher taxes, and politicians dislike punishing voters directly. The government can cut spending, but spending is attached to people, programs, contractors, agencies, retirees, hospitals, defense, interest payments, and promises. Cutting spending sounds easy until the cut lands on a real group with political power. The government can borrow. That is the easy path politically. It borrows by issuing treasury securities. Investors buy those treasuries because they want safety, yield, liquidity, or because the financial system needs them. Foreign governments buy them, banks buy them. Pension funds buy them, insurance companies buy them, individuals buy them, and sometimes during periods of monetary expansion, the central bank can add liquidity to the system by buying securities and expanding its balance sheet. That is the path modern governments prefer. Not because it is painless, because the pain is delayed. Borrowing lets the spending happen now while the cost is spread into the future through interest payments, refinancing risk, inflation pressure, and a larger debt burden. This is why deficits feel harmless in the moment and dangerous over time. The government spends today, the economy gets a boost today, contracts get paid today, salaries continue today. Markets may feel supported today, but the bill does not disappear. It changes form. It becomes interest expense, it becomes more debt, it becomes pressure on the currency, it becomes pressure on future taxes, it becomes inflation if too much money and credit chase the same amount of goods, services, and assets. That is why I call it a hidden tax. A visible tax takes money after you earn it. Inflation reduces what your money can buy after you keep it. One is obvious, the other is more deceptive. Look back to the early 1970s. A typical household income was far lower in nominal dollars. A typical house cost a fraction of what it costs today. A new car was thousands, not tens of thousands. College tuition was far cheaper. The SP 500 sat near levels that look almost unbelievable compared with today. Since then, Wages increased, but the cost of essential life increased faster. In many categories, housing multiplied far more than household income, cars multiplied far more than income, college multiplied far more than income, the stock market multiplied far more than all of them. Now let us follow the flow. The government borrows, treasuries are issued, financial institutions participate, banks, dealers, funds, and large investors absorb, trade, finance, and distribute those securities. Liquidity moves through the system. Capital looks for return. It flows into bonds, stocks, companies, real estate, private credit, commodities, and financial assets. Asset prices respond. Then, over time, government spending reaches the broader economy through salaries, contracts, benefits, programs, interest payments, infrastructure, defense, healthcare, and transfer payments. By then, prices may already have adjusted. That is why the people closest to the money flow often do better. They do not wait for inflation to arrive in their grocery bill. They watch it arrive in asset prices. Now let us discuss the three classic ownership paths. The first path is stocks. A stock is not a lottery ticket if you treat it properly. It is a piece of a business. A broad index fund is not a magic box. It is a way for an ordinary person to own hundreds of productive companies at low cost. Those companies sell products, raise prices, cut costs, reinvest profits, pay dividends, buy back shares, and compete for customers. Some fail, some become average, some become extraordinary. The index lets the winners do more work over time. This is why broad ownership is powerful. You do not need to know which single company will dominate the next 30 years. You can own a basket of companies that together represent a large share of the productive economy. If the economy grows in nominal dollars, if corporate revenues rise in nominal dollars, if profits rise over time, the owner participates. But the market will test you. There will be recessions, there will be crashes, there will be periods when stocks fall for reasons that sound permanent. There will be headlines that make cash feel safe and ownership feel foolish. The long-term investor must survive those moments. The person who sells every time fear arrives turns volatility into permanent loss. The second path is business ownership. A business is closer to the source of money than a wage. A wage is paid after the business decides what it can afford. A business receives revenue first, pays expenses, adjusts prices, manages costs, and then decides what remains. That position is powerful if the business has demand and discipline. A good business can respond to inflation better than a worker can. If costs rise, the business may raise prices. If demand is strong, it may maintain margins. If it improves productivity, it may earn more even in a difficult environment. A worker usually asks for a raise. A business owner can change the price list, but business ownership is not romantic. Customers are difficult. Employees leave. Suppliers raise prices. Mistakes are expensive. Competition never sleeps. A weak business can be worse than a job because it takes your capital and your time. The point is not that everyone should run a company. The point is that ownership of productive cash flow is different from dependence on wages alone. The third path is real estate. Real estate is attractive in an inflationary system because it is physical, useful, and often financed with long-term debt. If you buy a property carefully, the rent may rise over time while the fixed mortgage payment stays the same. The building can become more expensive to replace. The land can become more valuable as the surrounding area improves. The debt can become easier to carry. In inflated dollars, that is the ideal version. The bad version is very different. A property bought at the wrong price, with the wrong debt, in the wrong location, with weak cash flow can become a trap. Insurance rises, taxes rise, repairs arrive. Tenants leave, interest rates change. A landlord who bought only because someone said real estate always goes up may discover that leverage magnifies mistakes as well as gains. So the rule is simple. Stocks require patience, businesses require competence, real estate requires numbers. All three can help you move from wage dependence to ownership, but none should be treated like a shortcut. The first is stocks. A stock is not a lottery ticket if you treat it properly. It is ownership in a business. A broad index fund gives you ownership in hundreds of businesses. Those businesses sell goods and services, raise prices over time, invest capital, earn profits, and distribute value through reinvestment, dividends, buybacks, and growth over long periods. Broad stock ownership has been one of the simplest ways for ordinary people to move from wage earner to asset owner. You do not need to know the CEO of a company. You do not need private banking. You do not need a family office. you can buy broad, productive ownership at low cost. That is remarkable. But you must survive volatility. The market will fall. It will crash. It will test you. If you invest money you need next year, you may be forced to sell. If you panic during every decline, you will turn volatility into permanent loss. Stocks build wealth for the patient, not for the emotionally unstable. The second path is business ownership. A business lets you create value directly. It can raise prices, solve problems, hire people, scale systems, and generate cash flow. A small business can produce wealth far beyond a salary if managed well, but business ownership is hard. Customers complain, employees leave, competitors attack, costs rise, taxes arrive, mistakes are personal. There is no guarantee. Still, business ownership puts you closer to the source of money. Instead of waiting for a raise, you can create revenue. Instead of asking permission, you can solve a problem and get paid. That is why the wealthy love businesses. A good business is an inflation-adjusting machine if it has pricing power and real demand. The third path is real estate. Real estate can benefit from inflation because replacement cost rises, rents may rise, and fixed rate debt can become easier to carry over time. A property bought with long-term fixed-rate financing can be powerful if the numbers are right. The rent can adjust, the debt payment may stay fixed, the owner captures the spread. But real estate is not magic. Bad properties, bad tenants, bad debt, bad locations, and bad timing can destroy capital. A house you live in is not the same as an income-producing property. A leveraged investment can amplify gains and losses. Insurance, taxes, repairs, vacancies, and interest rates matter. The lesson is not that one asset is perfect. The lesson is that ownership is essential. The person who owns productive assets participates in the system. The person who only consumes and saves dollars gets diluted by it. Now let us return to the 1971 comparison. Household income rose, but the cost of life rose more in many critical areas. Housing, cars, and college did not merely rise because people became greedier. They rose because credit expanded, government spending expanded, money supply expanded, regulation changed supply, financialization increased, and demand met limited real-world capacity. The stock market rose even more because businesses adjusted to the nominal world. Revenues rose in nominal dollars, earnings rose in nominal dollars, investors paid higher prices for growing cash flows. Some of that was real growth, some of it was inflation, some of it was multiple expansion, but the owner participated, the non-owner did not. You must understand where you sit in the money line. If you are the last receiver, your life becomes more expensive before your income adjusts. If you are an asset owner, part of the same monetary pressure can appear as higher nominal values. That is the entire reason investing matters in a deficit-driven economy. It is not because investors are morally superior. It is because they own the claims that money chases. You must understand inflation. You must understand assets. You must understand debt. You must understand taxes. You must understand how money flows. You must understand that being the last receiver of new money is a bad position. The person who waits for higher wages to rescue him may spend his life behind the curve. The person who uses wages to buy assets moves closer to the front of the line. That is the real strategy. Use income to buy ownership. Use ownership to protect purchasing power. Use time to let ownership compound. Use discipline to avoid selling during fear. Use cash to avoid forced mistakes. Use knowledge to stop being surprised. Now, does this guarantee wealth? Nothing honest does. But it changes the odds. A person who spends everything and owns nothing has very poor odds. A person who saves cash but never invests has better odds in the short run but weak protection against long-term inflation. A person who owns productive assets, controls debt, keeps liquidity, and stays patient has the best chance of surviving a system where the dollar slowly buys less over time. That is the point. You do not need to become a hedge fund. You do not need to trade like Wall Street. You do not need to predict every Fed meeting. You need to understand the direction of the river and stop standing in the wrong place. If new money flows first into financial assets, then own financial assets. If real estate reprices over time with inflation, own real estate carefully. If businesses can raise prices and earn profits, own businesses directly or through stocks. If cash loses purchasing power, do not keep all long-term wealth in cash. There will always be reasons to wait. 1 year, the reason is recession. Another year, the reason is inflation. Another year, the reason is interest rates. Another year, the reason is politics. Another year, the reason is war, oil, banks, debt ceilings, elections, or market valuations. If your plan is to wait until the world looks safe, you may wait forever. The world rarely looks safe at the beginning of the best decisions. It usually looks confusing, overpriced, risky, or unstable. That is why you need a system instead of a feeling. A system says, I will invest steadily. A system says, I will keep cash for emergencies. A system says, I will avoid high-interest debt. A system says, I will buy productive assets, not lottery tickets. A system says, I will not let lifestyle consume every raise. A system says, I will not sell long-term assets because of short-term fear. A system says, I will not be the last person in the inflation line forever. That is how you change sides. Not in one heroic moment, not with one perfect investment, not by predicting every policy move. You change sides by repeatedly converting labor into ownership until ownership begins helping labor. At first, your paycheck does all the work. Then your investments begin doing part of the work. Eventually, if you are disciplined and fortunate, your capital can work harder than you do. That is the whole purpose of investing. Not to look clever, to stop depending entirely on wages, in a world where wages arrive late and prices move early. I want you to remember the 1971 comparison because it contains the whole story. Wages rose, but the cost of necessities rose faster. Stocks rose far more. Whether every number is perfect in every source is less important than the direction of the lesson. Labor income alone did not keep up with the full cost of modern life. Asset ownership participated in the monetary expansion. That is why the question is not whether you work hard. Many people work hard. The question is what your hard work buys. If hard work buys only consumption, inflation wins. If hard work buys only idle cash, inflation still wins slowly. If hard work buys productive assets, then part of the system that punishes cash begins working for you. That is the turn. Now let me close with the final choice. The government will continue to spend. The debt will need financing. Money and credit will keep moving through the system. Some people will receive the benefit early. Some people will receive the higher prices later. You cannot stop the whole machine by being frustrated with it, but you can choose your position inside it. You can remain only a worker and consumer, paid after prices already moved, or you can become an owner, slowly accumulating the assets that money flows toward. You can hold every extra dollar in cash and call it safety, or you can keep enough cash for emergencies and put long-term capital into productive ownership. You can complain that the rich get richer, or you can study why asset owners win in an inflationary system and begin buying assets yourself. That is the test. Not whether you understand the complaint, whether you act on the reality. The hidden tax will keep coming. It may come through groceries. It may come through housing. It may come through energy. It may come through tuition. It may come through insurance. But the investor has a response. Own the businesses that sell into the inflation. Own the assets that reprice with the currency. Own the productive engines that can grow nominal cash flow over time. Keep enough cash to survive, but not so much that inflation becomes your quiet partner in loss. That is how I would think about it in a world where the government borrows what it does not collect and spends what it does not have. The person who owns no assets is exposed. The person who owns productive assets is not guaranteed to win, but he is at least playing the right game. And in money, playing the right game is where wealth begins.